It says it right here. CNBC is warning us right now. Any money in a savings is losing purchase power over time. So one thing that this kind of, when I think about this, it's like, okay, well, if my money is losing a purchase power in the savings, then there has to be some type of vehicle, there has to be some type of plan or some type of account that I can put my money in where, it does the opposite. If this is going one way, I want to go the other way. I want to be on the other train. So now where we're at, to understand the next step as far as this process is understanding how banks work, because 9 times out of 10, you put your money in some type of financial institution, whether it's a bank, credit union, whatever the case may be. That's what we do. That's where we put our money because it's safe. We can access the money, and that's just what we've always done. That's what people have always told us to do. Because right now we're all depositors. We're all in this stage right here where we're calculating our money each month, and we put our money into banks. And I don't know if anyone ever told you this, but as a depositor, you're actually a lender to the bank. Because what happens is when the bank gets your check, gets your direct deposit or whatever the case, a lot of times you'll see that, oh man, I get this check, but I only have access to $100, or, I can only use a certain amount. That's because the bank is now taking that money and they're now reinvesting it. They're taking the pool of money, they're taking other people's money, and what they're able to do is put that into stocks and bonds, put that into real estate, basically flipping the money that they're giving from the depositors into an increase in their profit for themselves. And then that's not it. They also take that money, and you know what? They give it right back to us in the form of loans. So now we go to the bank to get a loan to get them to pay it off. And you know what they do? They charge us high interest fees. So the bank is getting money from the depositors, AKA the lenders. They're taking that money, investing in stocks, investing in bonds, investing in real estate. They're sending out loans to other borrowers who need the money. Then as they send that money, they're charging you a fee just to be able to use the money that you probably had to, do a whole bunch of stuff just to qualify for. But then the reward for being a member of a bank is very low when you look at the interest. I'm sure we can all look at our savings accounts. If you don't know your interest rate currently, it's less than 1%. The best I've ever seen was 0.1%, and that was Capital One. So if you have Capital One banking, that's great. You're one of those few who has a pretty decent savings account from savings account speaking. But again, 0.1%, your money is going to take a lot longer to double when you're earning an interest at that level. So we have to understand this concept to be able to understand how this can work in our favor. But as we can see, the bank is definitely coming out on top. And full disclaimer, this is not saying that banks are bad, because I believe that banks have their place. But when it comes to investing and looking into, again, putting your money in a vehicle that's going to be able to allow to do more for you, there are some different opportunities, and there are some different accounts that can now allow you to be able to do that in a more efficient way, if you will. So going into the next step, now we're going to talk about the enemies of our money. So we've talked about the banking concept, how banks are able to make money. Now we're going to talk about the things that we go through right now, the enemies of our money. And the first one is fees. So if you don't know, if you have a 401k, if you have any type of investment, any type of IRA, anything that's attached to the market, you are being charged a fee. Now, you might not see it. It might be under a different name, but everything that any type of investment tool, I should say, you're going to have some type of consulting fee, which is fair. It's a service that's being provided. So they have to pay the bills, if you will, and they're going to charge that fee. But that's something that we have to be aware of, because now we have to know, okay, I need to compare this to, is this fee that I'm being charged worth, the interest and worth the profit, that I'm gaining on the investment. The next enemy of our money is interest. A lot of times we don't understand that interest is not so much the APR. The APR is what they want you to see, the 8.5, the 14%, 6%. You're like, oh man, that's great. Yeah, I can I got a, 6% is a little is kind of a decent rate as far as a house, but it looks a lot lower than what it actually is, because what happens if you look at the house example here and you pay on this house for 30 years, the loan that you got was $250,000. So they paid for your house $250,000, but you paid for another house. You only have one. You have one house, but you pay for two. Look at that. You buy a car, 5 years, you paid $10,000. Essentially, you pay for another third of a car, but you're only driving one. Excuse me, I'm sorry, that was a credit card. If you're looking at the actual car, this would be about what? That'd be about a fifth. So again, the key is not necessarily the APR, but it's the volume, it's the APY. These are things that we have to look at. It's the amount of the debt that you have each month. That's what we're paying on, not necessarily the interest rate, because the interest rate is 8.5. But if you have 8.5 and you're paying the minimum every month, you're going to pay the bulk of that 19%. But if you have 8.5% and you're paying over the minimum, or you're paying the minimum plus half, now you're being able to knock your payments off at a lot quicker pace. So these are things, again, that we have to be aware of as far as the enemies of our money. Next, again, I just mentioned it a little bit. I'm not going to harp on it a lot, but inflation. Inflation is something that we're definitely feeling right now. I will update this at the end of this year, but I like to kind of let the year end to, reflect on the previous year. But last year, in October 2021, we had 6.2% of inflation. Normally it's around 3 to 4%. So 6.2 is a lot higher. And, it doesn't take a rocket science to understand that this is probably going to go up. If you think about Coca-Cola, or think about Pepsi, any type of soda, back in 1980, you probably could get it for 50 cents. You go in the store now, you're paying at least $1, at least $1.50, maybe $2 now. I don't really buy soda, so I can't speak on that, but you're going to be paying more. Prices are going to continue to increase. And this is the reason why we can get a promotion at our jobs. We can get a bonus at our jobs, but it feels like we're not necessarily making more money. Because you got that 2 to 3% raise, great. But if inflation increases at 4%, 5%, you're already working uphill. And don't let life happen and different emergencies and things like that. We all know these things happen all the time, but now with inflation, it's just another enemy that we have to be able to overcome and have to be aware of. So the next enemy, the final enemy, is taxes. You can't avoid paying taxes. You have to pay them. But I am of the mindset that if we can pay less, I would definitely want to pay less. Because you think about your money is taxed from income tax, you have excise tax, you have real estate tax, you have sales tax, gift tax, capital gains tax. Basically, U.S. families lose 36% of every dollar due to government taxes. So a third of your money right there is already going to any type of taxes before you even get to touch it. So if we can, why not pay less taxes? And this rule right here, IRC 7702, is going to actually allow us to be able to do that. Because what this rule is saying is that the death benefit distributed to life insurance contract beneficiaries is free from the income tax provisions, and any gains that build up within the policy during the policyholder's lifetime are not taxed as a part of their income. So that is just a fancy way of saying that any money that's inside of a life insurance policy essentially is going to grow at a tax-free rate. So again, when we talk about the IRA, the 401k, the TSP, the SEP IRA, the pension, these are taxable. So if the market is going up, that's great. But if the market is going down, you're losing money. So you do have that market volatility there. You're also, this is going to be money that when you get ready to distribute it. So when you have that IRA and you say, hey, okay, I have $1 million in my IRA, that's great. But what's going to happen is Uncle Sam is going to say, hey, I need 30 to 40% of that before you get to touch it. And so your $1 million just went down to about, 400, $400,000 just left your pocket that quickly. So again, not saying that any of these products are bad, because I would never say any investment product is bad for you, because if you're investing, then that's already half the battle. But again, if we don't have to worry about taxes, if we don't have to worry about market volatility, government penalties, or Wall Street fees, government penalties comes in where, let's say that we're going through life, I'm investing in this product, and I'm 45 years old, and now what happens is I need to use the money that I've been saving up because I have an emergency. I need to get a new car. What happens is, because I'm not 59 and a half, there's going to be a government penalty for accessing money within these plans right here. I'm going to say that again. Because I am not 60 years old, basically, there's going to be a government penalty for accessing money in these plans. Not to mention, when I do access the money, it's going to get taxed. Now, we said all of that. The key with the life insurance policy is that you get money that is tax-free. Now, why is it tax-free? The reason why it's tax-free is because the money that goes in there has already been taxed. The money is already coming from a tax standpoint. So you don't tax that money twice. You can't get into a situation where that would happen, but of course, I would make sure that you would not get into that situation. But for all intents and purposes, the money that grows inside the policy is tax-free. Again, the money that grows inside the policy is tax-free. When you get to a point when you are accessing it, that's your money. For me, when I was hearing that, it took me a couple of times to actually realize it, but tax-free is tax-free. If I don't have to pay 30 to 40% of the money, why wouldn't I want to give that to my family, or put that into my home, or put that into my business, or put that into me, put that into a vacation? Why wouldn't I want to do that? Why wouldn't I want to go ahead and make that happen? So these are some of the things, again, that we have to think about. There's no penalty, it's penalty free as well. So you don't have to worry about if you do need to access the money for whatever reason. No worries. All you do is just say, hey, I need to make a phone call, and then boom. And again, I would help you with that process, but it makes it so much easier for you to be able to access money if there is an emergency. But at the end of the day, it's risk-free. That's what I really love about it. I don't like the risk. If there are any traders or anything like that, if you guys know about trading, one thing I try to do is I try to minimize my risk as much as possible. That's anything in life, really. I try to minimize my risk as much as possible. Dot my I's and cross my T's. That's the name of the game, and that's how we're able to have money be our employee versus working for money. So now, how does this work? How does it work where, I'm putting money into a policy and I have access to it? What does that look like? What is that example? These are probably some of the questions you may have. And if you do have some questions throughout the time, you can definitely put those in the chat. We are going to have a Q&A at the end of this, but you might be asking that question. Hopefully you are. The way this works is that as far as the insurance, you're buying the least amount of life insurance and death benefit and living benefits to be able to have savings. So what this means is that you're offsetting your life insurance, whether it's 10% life insurance, 90% cash value, 20% life insurance, 80% cash value, whatever that discrepancy. I try to go at least to 80%. I try not to go under that, because at that point, it's not really as beneficial. You definitely want to have that savings potential. Now, the key is this. The cash value, that's what CV means, is earning at a fixed 2%. So that means year in, year out, you're earning 2% of your money, whether the market goes up, whether the market goes sideways, whether the market goes down, you're earning 2% on your money. Now, that might not seem like a lot, but when I get to these next few points, it's going to really all come together. Now, not only are you getting 2% fixed interest, but you're also getting annual dividends. Now, this isn't something that is guaranteed, so that's why I don't have a percentage for the annual dividends. But the dividends, usually, the companies I use have paid dividends at least for the last, if not 50 years or more. So it's a pretty, high chance. I can't say that, oh yeah, you're definitely going to have dividends, but it's a pretty good chance that you will. And these companies obviously want to do the best that they can for you because that means they can pay dividends. So you're automatically getting that. So you're talking about anywhere from 6 to 7, maybe to 8% growth each year based off of the fix that you automatically get, then another 4, 5, 6% from the annual dividends. And then the biggest key that I love is the compounding uninterrupted growth. So what that means is that the money is growing, and even though you're accessing it, it's still benefiting you. So even though, let's say that, I have it, and I'm actually going to show you an example, but let's say I'm accessing this money, even though I take it out and I use it and pay a bill, the money is still in there. I'm just pausing so that hits home. The money that you're using to pay your bills each and every day, even though you used it, is still in there for you. It's still in there earning interest, I should say. It's earning interest for you. Now, that's not in the policy where you can use it again. It doesn't work that way. If you use it, you can't just keep on using that same money. But the money that you're now using to take out is now earning interest for you. And again, I will go over that in much more detail as we go here. No Wall Street risk. You don't have to worry about risk as far as the financial fees or anything like that. There's nothing to do with that. There's no government penalties. So if you do need to access the money, as I was mentioning, access it, use it for whatever you need. I show you how to do that the best way to be able to make it still have the money still grow for you as you're going. And then the last benefit here is tax deferred growth. So we've been talking about tax free. Now the money that goes in the policy is tax free, but then there's this thing called interest that grows off of the money that is already in the policy. Is essentially money that you've earned from the interest rates. So that money is tax deferred, but everything else as far as the money that goes in is tax free. So I do want to make sure that I'm clear on that. Now, again, the cool part about this is that even though, yes, I'm putting this money into the policy, I have immediate access to 80% of the cash value. Now, again, you might have more access, but what I like to do is I like to lowball and say 80%. And if you have more, you'll be excited. If you're at 80%, then that's what we said. So I like to definitely be conservative. Again, you have access to the money 100% tax free. Now there is no free money. There is an expense for the loan, but it's not a compounding interest like normal loans. It's a simple interest. So it actually ends up working in your favor the way it works. And I'm not going to harp on the loan too much because there's a couple features that this really changes the game for a lot of people, and it just changes the game from a financial standpoint because you can choose to pay yourself with interest on the loan. You can pay the interest only. You can pay any amount, or you can let the dividends pay, or you can say, hey, I'm not going to pay anything. And then what happens is the loan that you've taken out, it will be lower than the death benefit that will go to the beneficiary. So any of that money that you actually use, it would just be subtracted from that death benefit. And the way I set up policies, you would basically be able to use, hundreds of thousands of dollars and still have access. Your family still have access to six figures, if not more, depending on the investment and depending on the goals. So that's, again, is a very powerful measure. It's very powerful to be able to, again, say, hey, I'm not only am I paying my bills and everything is together, but now I'm in a place where, if I'm not able to pay this, then I'm still fine. I don't have to worry about, putting this back in and having something bad happen, or having somebody come take my vehicle if I don't make this payment or anything like that, or I have to put up something as collateral. You don't have to do that anymore. You actually have access to the money. You actually are basically empowering yourself here. All right, so it looks like I got about 10 minutes, so I'm gonna go ahead and do that here. So lastly, what I like to do is go over the final example here. And this is essentially how we purchase vehicles right now. So right now we would go to a bank. And we would say, hey, I found a car, it's $50,000, I love it. Can you give me, what would you be able to give me as far as, interest rate and things of that nature? So what happens is they end up giving you 6 year and you make 72 payments. Your payment is $889. So what's happened is you have now put this money into the policy. You put this money into the bank, $889, and you've paid $64,008 at the end of those 6 years. And then the only thing that you have after that 6 year time frame is $10,000. That's the only thing that you have in the first scenario. But in this scenario, if we're putting our money into this policy first, what happens is taking out the 889 for the same time frame, even though we use that money, this is all growing for us as far as interest, plus you get dividends. So again, I'd rather have $74,000 plus dividends than just have a $10,000 car at the end of 6 years. And this is just a car example. You can do this with so many different things, from a mortgage, credit cards, business expenses, personal loans, rentals, household expenses, anything that basically you say, hey, I want to pay, this is a big payment. I kind of want to pay this off. I don't want this, hanging on my credit for a long time. This is the perfect plan to be able to do that and to be able to just take it to the next level. If you saw something that you liked, or maybe you want to learn more about it, please don't hesitate to go ahead and book a time on the Calendly link that's located under the video. I'd definitely love to get with you, and everybody's situation is going to be different. So I'll be able to run those specific numbers for your situation. They say the best time to plant a tree was 10 years ago. The second best time is going to be today. Again, I'll say the best time to plant a tree is 10 years ago. So you might not have known about this 10 years ago, but the great part about it is now. You can take advantage of it now, and we can get started today.